In today's episode, I'll talk about three interesting stories. In the first story of the day, I'll talk about what exactly is happening in the aviation industry of India, with IndiGo going a little premium and Vistara and Air India merging. In the second story, I'll analyze Tata Motors' latest quarterly results and what they tell us about India's automotive sector and also India's upcoming EV sector. And in the third and final story of the day, I'll talk about Dr. Reddy's big bet on Ozempic, which is a miracle weight loss drug which could also cure diabetes. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet is one level deeper and comprehensive as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 12th of November. Let's begin with the first story of the day and talk about India's aviation sector, which is taking off in a big way now. Now, recently, the aviation sector of India hit a major milestone and it became the third largest aviation market in the entire world. Now, this means that more people are flying in India than almost everywhere else in the world. And this is driven by a mix of rising demand and a growing number of airplanes in the sky to meet this demand as well. Now, this is a huge change, especially considering how the industry had struggled during the COVID-19 pandemic. But now it is bouncing back in a pretty strong way. Now, the interesting thing about this sector in India is that just about 3 airlines today control over 90% of all domestic demand of flights: IndiGo, Air India and Vistara. Now, with these 3 giants leading, it is almost like a tight race where all of these airlines are making very careful moves to come out on top. So in this story today, let me talk about what these specific airlines are doing and how they are contributing to shaping up India's aviation market in a big way. Let me start with IndiGo first. See, for many years now, IndiGo has been the dominant player in India's skies. It is known for its straightforward, no-frills approach as a low-cost carrier, or an LCC. Now, in case you're wondering what being a low-cost carrier really means, essentially IndiGo keeps things very simple. They use a single type of aircraft, which by the way is the Airbus A320 family, and this makes things more efficient for training pilots and also maintaining airplanes. There are no free meals and no extra perks on the airplane. Passengers have to pay for whatever they want. So all of this keeps their costs low and also lets IndiGo offer cheaper tickets, and this has made it very popular with budget-conscious travelers who just want a good deal. But what is interesting here is that IndiGo's ways of cutting costs go beyond what meets the eye. To give you an instance, they skip things like onboard ovens, and this reduces weight, therefore reducing fuel costs in a big way. Plus also there's the fact that they always buy airplanes in bulk, which gives them a better deal. Now all of these small savings keep adding up, and this has over time allowed IndiGo to keep fares low while still making a lot of money. Now Aditya Ghosh, who was one of IndiGo's early leaders, summarized it very well when he said, and I quote, "Anyone can be a low-fare carrier, but only the sharpest managements can be a low-cost carrier." Now, it's a very subtle but a very critical difference that has kept IndiGo at the top with about a 60% market share of India's domestic market. But now, IndiGo is trying something new. They have recently launched something called the IndiGo Stretch, which is their version of a business class, so to speak. Now, for a budget airline, this is a very interesting move. IndiGo Stretch, for your reference, gives passengers wider seats, extra legroom, and even gourmet meals that are crafted by chefs from the Oberoi group. Then there are also perks like priority check-in, etc. Now, of course, this is something you would not quite expect from a low-cost airline, right? Globally, most of the budget carriers like Ryanair or EasyJet do not usually dabble in premium services at all because they don't bring in high profit margins. So IndiGo's move into business class raises some key questions for us. First, can they balance this new premium service with their low-cost model? And second, will they be able to attract new type of passengers without quite diluting their brand as a budget-friendly airline? Now, of course, only time will tell us the answer to this, but this seems like a big strategic shift in IndiGo, which all of us as investors must keep a close eye on. Then let's move on and talk about a big change that is also unfolding in aviation right now, and this involves Air India and Vistara. Now, starting November 12th, Vistara flights will begin operating under the Air India name, and this will create a single large airline that will serve over a quarter of India's domestic market. Now, this merger is a huge deal for several reasons, but let's take a step back for now and understand how we exactly got here. See, Vistara was launched by the Tata Group as a premium airline that was focused on delivering a comfortable, high-end experience for its passengers. Now, this included things like premium economy seating and also a focus on better in-flight services. Now that Vistara is merging with Air India, the Tata Group has said that they plan on keeping Vistara's premium standards alive even within the Air India brand. So for Vistara fans, the hope is that top-notch service that they love will still continue, just under a different name this time around. But the thing is, this merger is not just about combining two airlines. It is also a bigger strategy by the Tata Group to bring all of its airline holdings together into one single stronger full-service airline. And they're not doing this alone, by the way. They're also partnering up with Singapore Airlines, which now holds a 25.1% stake in the combined airline entity. Now, this partnership could be a huge win for Air India because it brings in international experience and connections that could help improve its service quality to a great degree. Now, as part of all of this overhaul, they are also rebranding their loyalty program as the Maharaja Club, and they are integrating it with the Star Alliance network. If you are a frequent flyer, this could mean more rewards and also more benefits whenever you choose to fly with the new Air India Airlines. The idea that Tata Group seems to be exploring here is to make Air India a top-tier airline in the country which competes against international standards. In contrast, by the way, IndiGo is still sticking to its budget routes, but they are still dabbling into premium options with things like IndiGo Stretch and also their loyalty program called Blue Chip. So if you think about it, this creates a very fascinating dynamic where one major airline is trying to climb the service ladder while the other one is very cautiously testing the waters of premium travel. Now the thing is, these are not just corporate moves, but they could directly and very significantly impact travelers like you and me. See, while Air India's merger with Vistara does promise a better experience for those who are looking for a full-service travel option, IndiGo's new business class could offer a more affordable way for budget travelers to enjoy a bit of added comfort. So all in all, in short, while IndiGo is sort of tiptoeing into the premium market, Air India is working to become a full-service giant. But in all of this, there is a potential downside that we all must notice. See, with fewer airlines in the market now, competition could decrease and this could lead to higher ticket prices. The logic is fairly simple here. When fewer players control the skies, there is usually less pressure to keep fares low. So while travelers might definitely benefit from improved services, they also might face steeper costs of flying overall. So looking ahead, both IndiGo as well as Air India as an entity now have big tasks on their hands. IndiGo will need to balance its low-cost model with the demands of its new premium service. For IndiGo, if it goes too far with this, it risks losing all the simplicity and cost advantages that have made it so popular today. The challenge for Air India, on the other hand, will be scaling up Vistara's high service standards across a much larger operation scale. Now, of course, merging two airlines is not at all easy, and maintaining quality while expanding is a fairly tough balancing act that we all as investors must keep a very close eye on. Let's now move on to the second story of the day and talk about the auto industry in India. See, whenever we think about the auto industry in the country, Tata Motors is a very significant name that stands out. Now, this company is not just one of the oldest players in the Indian automobile space, it is also one of the most versatile ones. They produce everything from trucks and buses to luxury vehicles like Jaguar and Land Rover. Now, this gives Tata Motors a very wide reach, and how well Tata Motors performs also can give us a great sense into the broader auto industry's health. Now, recently Tata Motors shared its performance results for the second quarter of FY 2025. Overall speaking, there was a dip in revenue as compared to the same period last year. This drop was around 3.5%. Now, maybe this might sound small to some of you, but for a giant like Tata, this can still signal some big challenges. Now, behind this drop, there were some specific issues that were faced across three key segments that Tata operates in. First is its luxury arm, which is Jaguar Land Rover or JLR. Second is its commercial vehicles divisions or CV division. And the third is its passenger vehicles or PV division. Let's quickly take a closer look at each of these and understand what is exactly going on. Let me start by talking about JLR or Jaguar Land Rover. See, like I mentioned earlier, this is Tata's luxury brand which is known for high-end cars like the Range Rover and Jaguar models. Now, this division is Tata Motors' biggest moneymaker. It is responsible for close to 70% of its total earnings. JLR also puts Tata Motors in direct competition with global brands like BMW and Mercedes, and it also brings the company international recognition and a substantial slice of revenue. Now, while JLR is a strong brand, this time around it has faced some setbacks due to unexpected supply chain disruptions and a few other challenges as well. The first challenge is supplier flooding in Switzerland. See, one of JLR's main suppliers, which provides aluminium, which is a crucial material for making vehicles, faced severe flooding this time around. This disrupted their supplier operations and slowed down JLR's production schedules. The second thing is delayed quality checks. See, about 6,000 JLR vehicles that were meant for the UK and the European Union markets got delayed due to last-minute quality inspections, which even further impacted deliveries as well as revenue as a result of it. Now, because of all of these issues, JLR sales volumes dropped by about 10% and total sales slipped to 87,300 units. And this decline resulted in a 6% drop in JLR's revenue. Also, China, which is JLR's third largest market, brought its own set of difficulties. There was a wave of financial troubles among dealerships where several dealerships went bankrupt, and this created a domino effect. The collapse of some dealerships made it very hard for others to secure financing, and this further weakened JLR's regional sales and their distribution network. Now, this dealer crisis is now making it even tougher for JLR to keep up smooth sale operations in one of its major markets, like I mentioned. But despite facing all of these challenges, the JLR management seems to be fairly ambitious about the company's future growth plans. They are now focusing on a strategy called Reimagine, and this is a £500 million investment into a shift to electric vehicles. For your reference, by 2030, JLR is aiming to go fully electric. So this investment could create the way for JLR to not just bounce back from this quarter's setback, but also lead the luxury EV space in the many years to come now. With that out of the way, let's now move on to commercial vehicles, where Tata has really deep roots. See, with about 30% of market share, Tata is one of the biggest players in this segment. Tata's trucks, buses, and other heavy-duty vehicles have for very long been the backbone of Indian transportation, and they have served industries from mining to construction and whatnot. Now, the reason this is important is because commercial vehicle sales tend to mirror the broader economy. When the economy slows down, so does the demand for heavy vehicles. In this quarter, overall commercial vehicle sales in India dropped by 11%. But the thing is, Tata saw an even bigger decline over here, and their sales fell by about 19%. I'll further break this down for you very quickly with the kind of vehicles that were affected. Let's first talk about heavy commercial vehicles. Now, these large trucks faced a sharp decline, and their sales dropped by about 24%. The second one is medium commercial vehicles. Sales here were down by about 13%. For small commercial vehicles, sales dropped by about 10%. But the only bright spot in the commercial vehicle segment was bus sales, which grew by about 5%. According to Girish Wagh, who heads Tata's commercial vehicles divisions, three major factors affected this segment. The first one was lower infrastructure spending. See, ahead of the elections, government spending on infrastructure usually tends to slow down a little bit, and this reduces the need for heavy vehicles like trucks. The second reason was reduced mining activity. Of course, if there is less mining, fewer trucks are needed in order to transport materials from one mine to the other parts of the country. The third reason was heavy rains. See, this time around, there was an unusually strong monsoon season which disrupted freight movement, affecting truck usage across the country. But despite all of these negatives, there is still a bit of hope here. The month of October saw a slight rise in fleet utilization rates, which means trucks were in more demand, and this hints that commercial vehicle sales may start picking up once again very soon. Now, moving on, Tata is making some really big moves in the electric commercial vehicle space, particularly with buses. Tata now has over 3,300 electric buses on the Indian roads, and they collectively cover more than 200 million kilometers with a remarkable 95% uptime. Now, these buses are helping push India's shift towards electric public transport, and Tata is in a big way leading in this space. Let's then move on and talk about the next segment, which is the passenger vehicles, and this is a segment that has transformed pretty significantly for Tata over the last few years. To give you some context, just a few years back, Tata just had a 4% share in India's passenger vehicle market, but today this very share has shot up to 13%. Tata today leads the Indian EV space, and they command about 65% of the market. One huge trend in Tata's passenger vehicle segment is the rise of alternate fuel vehicles. CNG and electric vehicles both now make up a third or 33% of Tata's passenger vehicle sales. And this shows how customers are very quickly moving towards cleaner fuel options. But the interesting thing to note here is, despite Tata's strong position here, passenger vehicle sales softened a little bit this quarter. To help its dealerships manage their inventory a little more effectively, Tata also reduced the number of vehicles that it sent to dealers. But the thing is, this move did not quite impact retail sales. Tata this time around recorded its highest ever retail sales in the month of October. By holding back on dealer inventories, Tata is aiming to align its growth more closely with actual market demand in order to avoid excess stock in dealerships. Now, while Tata has definitely maintained its dominant 65% EV market share in India, demand has softened a little bit after the end of government's FAME 2 subsidy scheme. Now, for your context, this scheme by the government provided incentives for EV vehicles. So Tata's commitment to offering multiple powertrain options, which is petrol, CNG as well as electric, for all of its vehicles shows its dedication to meeting the diverse needs of our Indian consumers. So after all of this, the question for you and me as investors is, What does this exactly mean for Tata Motors and for the auto industry of India? Let's take it step by step, starting with luxury vehicles. See, JLR, like I mentioned, faced some serious production setbacks this time around, but the good news is that the demand for flagship models like the Range Rover still remains robust. Tata's strong investments in EVs under the Reimagine strategy could make it a pretty resilient player in the luxury EV space in the near future. The second thing we'll talk about is commercial vehicles. Now, of course, this segment's performance, like I mentioned, is very closely tied to economic conditions. The decline this quarter sort of mirrors the effects of a slowing down economy, but the recent uptake in fleet utilization also suggests a potential recovery on the horizon. The third is passenger vehicles. Of course, Tata's turnaround in passenger vehicles is pretty remarkable. It has gained market share and has become a leader in India's EV space, like I mentioned, and it still continues to evolve its offerings in order to align with the changing consumer preferences. So overall speaking, Tata Motors' performance this quarter gives us a pretty clear window into the challenges as well as the opportunities in the country's auto industry. While each division has its own hurdles for sure, Tata's investments in EVs and adaptive strategies definitely show an intent to remain competitive across the entire board. Now let's move on to the third and final story of the day and talk about a drug that is threatening to change a lot of things in the pharmaceutical world, Ozempic, and a similar drug called Wegovy. Now I'm sure most of you listening to this have heard of these drugs in at least passing, but still let me break down what they are and why do they matter to us. Look, originally Ozempic was developed in order to treat diabetes by helping patients regulate blood sugar levels. But it didn't quite stop there. Ozempic and Wegovy, both made by a Danish company called Novo Nordisk, have recently become very popular weight loss solutions. Now this brings their active ingredient called semaglutide into the spotlight. Now Dr. Reddy's, which is a very well-known pharmaceutical company from India, is now gearing up to enter this weight loss and diabetes market. Their plan seems to be to make an affordable version of semaglutide, which is aimed at offering an option that more people can afford, especially in a country like India, where high costs can often put these treatments out of reach of most. Now, to understand why Dr. Reddy's move is so important for us, let's take a closer look at semaglutide itself first. See, when Novo Nordisk first created this drug, they designed it to help people with diabetes, like I mentioned. Semaglutide works by mimicking a natural hormone in the body called GLP-1, the full form of which is glucagon-like peptide 1. Now, GLP-1 helps manage blood sugar and also reduces hunger by making people feel less full after eating. But as it turns out, semaglutide also has a bonus effect. It also slows down digestion, and this helps people feel full for much longer. Now, this appetite control has turned semaglutide into a really powerful tool for weight loss, especially as more people are seeking solutions to manage their weight. Now, since its popularity is rising so quickly, its price is rising as well. In the US, for example, a month's supply of Ozempic can cost over $900. And this is a big expense for many people, especially in places with lower average incomes like India. Now, this issue of high costs is becoming even more serious as the demand for weight loss solutions keeps growing. The global market for GLP-1 drugs is expected to reach about $100 billion by 2030. So an affordable alternative could be a game changer, so to speak. Dr. Reddy's laboratories sees a huge potential in offering a more budget-friendly version of semaglutide. And this is even more important given India's rising rates of obesity and diabetes. This is a major public health concern in our country because by about 2035, around 11% of India's adult population is expected to be obese, and our diabetes rates are amongst the highest in the world currently. So having a cheaper version of semaglutide could make a real difference for millions of people who currently cannot afford such expensive treatments. But of course, there is a catch to it. Producing a cheaper version of semaglutide is not as simple as setting up a factory and getting started. In the world of pharmaceuticals, patents are a huge deal. For your reference, patent gives original creators like Novo Nordisk in this case the exclusive right to make as well as sell their drugs for a certain period of time. Currently, Novo Nordisk holds the main patent on semaglutide, which allows them to control its manufacturing as well as its sales. Now in India, this patent is set to expire in 2026. And once it expires, other companies, including the likes of Dr. Reddy's, could technically start producing semaglutide, but only if they meet certain legal conditions. Now the only issue here is that Novo Nordisk has also filed extra patents which are called secondary patents on specific details of semaglutide, like its manufacturing process as well as packaging. Now the thing is, these secondary patents could last until 2033, which could create additional hurdles for any company that is hoping hoping to replicate the exact truck. But despite all of these obstacles, Dr. Reddy's is not quite waiting around. They're investing heavily in infrastructure now so that the moment the main patent expires in 2026, they will be ready and waiting to launch immediately. Their idea is to hit the ground running with an efficient end-to-end operation that is capable of producing, packaging, as well as distributing the drug without any delays. And it's not just Dr. Reddy's, by the way. Other big players in India like Biocon and Sun Pharma are also preparing to enter the GLP-1 market once the patent starts to loosen up. So this competitive landscape makes Dr. Reddy's readiness very crucial. They need to have everything in place so that they can be the first, or at least amongst the first, to offer a more affordable option when the time comes. For your context, Dr. Reddy also right now has a bit of help from the Indian government. India's PLI, or Production Linked Incentive Scheme, is a government program that is aimed at encouraging local production of essential drugs, including the likes of GLP-1 based treatments like semaglutide. Now, this program could provide companies like Dr. Reddy's with the resources as well as the support that is needed to get generic versions of semaglutide to market much faster once they have legal green light. So if Dr. Reddy's manages to pull this off, the impact could be very significant. Not only would they tap into a lucrative market, but they would also potentially help millions of Indians access vital treatments that were previously unaffordable. Also, as more and more companies enter this space, there could be increased competition, which could eventually help bring down prices even further. Let's now move on to the final section of the day, which is the news tidbits. First, FDI in India's non-conventional energy sector surged 35% in Q1 of FY 2025 and reached 1.04 billion. Traditional sectors like telecom and pharma saw declines though. Now this shift underscores India's ambitious 2030 target for 500 gigawatts of non-fossil energy capacity. Second, India's three-wheeler segment faces a 15 to 18% price rise as subsidy caps are hit early under the PM e-Drive scheme. This could slow adoption and strain dealers and manufacturers as costs start to increase. Third, shares of major Indian solar manufacturers plummeted following Donald Trump's announcement to halt renewable energy projects, which affected companies like Vari Energies, which export to the US. Fourth, onion prices in major markets have now hit a 5-year high, and this is driven by poor crop quality and heightened export demand from other countries like Bangladesh, which have created domestic supply pressures. Well, that's all the news and stories I have for you today. I hope you found value in today's episode and learned something that you had not previously learned about. Please do leave your thoughts in the comments down below and we would love to have a chat with you. As usual, this is your host Anurag Bansal signing off. Take care and I'll see you tomorrow. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.